Chris Salmon, Chief Investment Officer. It would depend on the level of divestment. I have said to you before, we're really right at the point of they have all been very small, but those are straws, and we're right at the point of breaking the camel's back, where in those capital market assumptions, Josh and Geraldine would ratchet public equity down 1/10. Sounds small, but that compounds into everything else. And so it would actually change these cost figures slightly, and it would change the success of the plan slightly. The more we add divestment. Now, if you do divestment of a major industry, then you run the risk, because again, that's a forecast of the future that you think that industry is not going to do well. But we would look at these numbers and have to take the conservative estimate that it would potentially be a risk, lower our diversification and increase the risk, which again, on this slide would increase the cost to members and decrease the probability of reaching full funded status.
If I could jump in and just provide maybe a forward-looking statement. One of the aspects we're analyzing now and educating the board on, you'll hear later in the meeting, is the potential for a risk budget. And to Gail's point, one of the things that we could analyze and attribute as part of the risk budget is the amount of the divestment. And as Chris was saying now, if we were to analyze it, the allocation, that's fairly small. And so it doesn't really affect the implementation risk of the program significantly, but it'll be something that we could quantify looking forward if we were to set a risk budget framework. And I think that would be good, because then we would continually be reporting on that attribution. Since January of 2000, what has been the performance of our divestments, we've underperformed roughly by the tune of $5.8 billion. The majority of that has been the tobacco divestment. It could bounce either way. I mean, what we've done is just we've excluded that from the universe of our investments, and the way that the industry is, how it's affected the returns is roughly, $5.8 billion.
Yeah. In terms of strategic asset allocation, no one knows what the return impact will be of divestiture, and it could be positive or it could be negative. What we do know is it will reduce diversification, and if you reduce diversification, you increase volatility. So the assumption that goes into the model could modestly increase the volatility of the public equity asset class, which would change the risk-return characteristics of the total portfolio.
Thank you. That's really helpful. And then to the contribution side, Mr. Lamoureux, so I am anxious about the world and the economy generally. I think that's what makes this an especially difficult decision for the board and also for the state of California, who's, as we just learned, on the hook in addition to the 2% at 62 members. I think there's a shared liability there that can be a little bit nerve-wracking, and the economic factors that impact the portfolio also impact tax revenue in the state. So as we see the portfolio declining, it's entirely possible that we see state revenues declining. And so therefore, I feel really anxious generally about what the world looks like, and what impacts that. So to Mr. Lamoureux, when we're thinking about the member contributions at 10%, the employer contributions at 18%, and the 11% for the state, how do you see? So we understand the effect on Ms. Hendricks asked about the 2% at 62. I'm wondering kind of what you've modeled in terms of the state contribution increasing in addition to the PEPRA legislation that we discussed from Governor Brown.
So when you're talking about modeling the state contribution rate, some of it was on the slide deck as part of the model. The reality is investment volatility is going to be borne mostly through the state contribution rate. And I think we've highlighted that several times in the past. It was built into the model. Can you just go to the slide?
I think that was the one that was cut off, right?
No, yeah, so on this one here, what we've modeled is if we were to go to 6.75, and again, so this is just in the, this is not really subject to, this doesn't really factor in if there was an economic downturn, all we're saying is that if instead of assuming 7, we now assume 6.75, that 0.25% of investment income that we would otherwise generate has to be made up through contributions. And the way it would be made up is the 2 at 62 members would send us about 0.5% more, and we would need 3% of payroll more from the state. So if you look at today's total payroll for all of our teachers, you're looking about just over $1 billion in the first year is what you would be looking at. And that would be from this. But this is not from what could happen if we earn less than we assume. This is simply, now we're thinking we're only going to earn 6.75 long-term and not 7. So to make up the difference, we need 3% more from the state. So it would go up by 3%. But then if we had volatility, then again, it would have to come from the state.
I appreciate that. Thank you. And then my final question is just to the real estate portfolio. When you come back to Mr. Persant's point about the collaborative model in private equity, if we could, I understand that there have been some co-ownership opportunities, and if we could just perhaps understand how those opportunities could, I think the real estate 15% is attainable. We're at 13.4 now. So I would just be interested to see how the co-ownership opportunities could be helpful. And then to the controller's point, even in an economic downturn with the huge impacts on real estate, if that at all makes even a small difference in terms of our risk when we look at that portfolio as well. And then actually I had one more question. I understand that the inflation sensitive, even though we're going from 2.5 to 6, is it true? So half of that would be from infrastructure, private owned infrastructure, and half of that is from commodities. Do I understand that correctly? For the getting to the 6% in infrastructure.
And while Paul's coming up, the way that we model all the asset classes, we meet internally with every class to kind of talk about what their expected structure will look like. So the assumptions that we built into the modeling for inflation sensitive, it is roughly half infrastructure, actually a little more than that. And then the rest is kind of a mix of commodities and some other private strategies and TIPS, Treasury inflation securities. So it wouldn't all be commodities. That would be a small piece of kind of that remaining 40 to 50%. In terms of how the modeling assumptions work.
Paul Shantic, who oversees. Hi, Paul Shantic, Director, Inflation Sensitive. Normally, what we've tried to run the portfolio between 65 to 70% of that is in infrastructure, and the rest would be spread through TIPS and commodities and other aspects of that portfolio. Timber and agriculture could also be part of that as well.
Okay, great. And the infrastructure is largely global infrastructure by the privately owned infrastructure projects, or is it? How volatile is it in terms of the international geopolitical?
The setup is supposed to be less volatile. A lot of our infrastructure is still in the U.S. We do have some outside of it, and we try to stay in the OECD countries and away from some of the more volatile regions of the world.
Thank you very much. Well, again, I really do appreciate this and the thoughtful discussion, and thank you again to the staff.
Thank you, Gail. Keith?
Yeah, thank you. A couple lines of questioning. The first line is, how long is this asset allocation to be effective? I mean, I saw the process, and I've read perhaps every 4 years you come back, but then Chris said, we've developed previously had developed some asset allocation, and we've gotten it partially implemented, but not all the way because, of the need to be smart about it. So when would we be revisiting this if necessary? I mean, do we have the option to come back in a year or 10 years or what?
So I'll take a first stab at it, and then if Scott and Chris want to jump in. So the formal study is every 4 years, but I think your question is, when you're implementing it, how will you revisit it? We actually change the policy. When we come back with steps, it will be brought to you when we're ready for the next step, and when we be reporting on where we're at in that process. So you will see it and you will hear about it all the time. And it won't necessarily, we're not going to have a formulaic step because we don't want to force and get the bad managers, and we want to make it flow as it makes sense given the economic environment. So I'm not telling you in 4 years we'll be at the end game, but you will know about it every time we come back and we're ready to step to the next phase.
So it really is that these decisions that we make have more an effect on our ability to allow the liability side to make the assumptions and
Well,
based on and make its projections, including funding status and all that, and needs, based on the actual decisions we made to allocate as opposed to the actual allocations itself and the results that come from that.
yes, I'll let him answer that, but I want to I do think it means something on the asset side. It's basically a green light to move in that direction, right? You're telling these private asset owners or managers to, in real estate and, okay, go look for these deals, look for it. We're trying to move in that direction. So it is actually a big signal and message to the investment portfolio too, but it means something on the liabilities too.
And on our side, we're less worried about if it's going to take 1 year, 2 years, 3 years to get there. We view it as this is the decision the board made long term. A lot of the work we do, we look ahead 50, 60 years into the future. So what we do is we base all of our modeling assuming that this is going to be our long-term state. This is how we're going to invest the assets. We're less worried if it's going to take 1 year, 2 years, or 3 years to get there. We assume that we will get there in the long term, and so that's how all of the modeling is done on our side.
Okay. So as a practical matter, we make this decision. It may or may not totally be implemented by the time we decide in 4 years or 10 years that we want to change that allocation, but it allows you to make your projections, the effective projections in which the ongoing funding and other kinds of decisions are being made.
There's one other thing that hasn't been said. It's important to keep this in mind. These are targets. There are ranges around the targets. If you're ever exactly your target, it would be shocking because of both capital flows and capital markets. And the staff has some level of discretion. In fact, you're going to be discussing that later when you talk about tracking error. And they use their judgment in slightly overweighting or underweight different components over time. So as Geraldine said, the key issue is direction. And this is going to give the staff direction on where to put the assets. They're not going to throw the money at the market if they don't think it's reasonable and prudent to do so. But they would come back to you with the reason why they did not take any action or took an action if the opportunity presented itself.
Thank you. And the second line of questioning is just from the asset side, I guess you call it, the investment issues. What are the assumptions, or maybe I should say, I don't need to know every assumption. What would be do you just look at assumptions based on the historical record, or do you project any factors into the future based on what's happening now or whatever? There are current issues that affect the uncertainty about the world economy. But so what assumptions would you make that are forward-looking as opposed to backward-looking?
Josh looks up, down,
Go ahead, Josh. Let's talk about well, basically, there's a building block methodology where you start out with what do you believe inflation will be. In this case, we've deferred to the actuary in their long-run inflation. Then you add a series of premiums based upon generally using common sense and looking at history and where we are. The easiest one is fixed income, because right now we know what the yield to maturity is on a 10 or 20-year bond. And historically, that's been a very, very good indicator of what the return on fixed income would be. Looking at the public markets, basically you're saying, based on history, where are we in the pricing cycle? Are the markets rich or the markets cheap? And using judgment in that context. And then doing that for each component of the portfolio, but it really is keyed off of starting with inflation and then getting risk premiums for each one of the various asset classes. And looking at their historical relationship, because literally looking at those relationships is almost as equally important to the return on the degree to which you will get the benefits of diversification. And what we'll be happy to do is provide you with the background paper on assumption setting that we can answer in more detail at your convenience.
Yeah, I don't think I need a paper, but maybe talking to you later. Thank you.
Hey, great. Thank you so much. I don't see anyone else in the queue. Thank you to the staff, consultants, board members for your line of questioning. Look forward to the item coming back in November. Thank you. Great. Brings us to item 4 on the agenda. This is Kirsty Jenkinson, the director of our SIS program, Sustainability Investment and Stewardship Strategies. This is an action item with some proposed changes to policy, and Aisha Mastegi is accompanying Kirsty. I'll turn it over to the two of you.
Great, thank you, Mr. Cayley. I'm Kirsty Jenkinson. As the Chair explained, I am the Director of our Sustainable Investment and Stewardship Strategies Programme. I'm joined with my colleague Aisha Mastagi. We're going to be talking about some revisions to our policy that governs the activities. But before I hand it over to Aisha to run through the proposals that we're making today, I just wanted to clarify a few points up front. The first, I think, is important as we continue to obviously get to know you as our new board members, is to reiterate again the goal of the programme that I oversee, which, if I have to, as we've been developing our strategic plan since I came on board 8 months ago to build on the work and the legacy that obviously CalSTRS has led in the market for many years, is the way in which we can look to be a catalyst for financial markets to focus on long-term value creation that values appropriately and integrates sustainability and ESG considerations. And I think you'll agree that this focus that we have both aligns with the long-term interests that we've just been discussing in the asset liability management study, and also as we increasingly get to a more crowded and resource-constrained world, the way in which these factors are going to influence the value of long-term shareholder returns. So what we're going to be doing in terms of this policy today brings us back to the 3 elements of the programme that I'm continuing to emphasise, that I would like our strategic priorities to be. The first is how we allocate our capital. This is the investment part of our portfolio. You will be seeing an expression in the semi-annual reports about how we are looking to reshape that portfolio going forward, both in terms of balancing the activist elements that we have in it with the sustainability managers that we invest in as well, and new opportunities that we're looking to pursue to allocate capital to businesses that create sustainability transformations. The second part of the strategy that we focus on is obviously stewardship, the way in which we use our influence as a major global investor to influence sustainable business practices, and I can't underestimate how important that role is. We'll be talking with the board more about that in November as we discuss our engagement plan and our prioritization, which we take very seriously. And then also the strategic relations that we have, which we think is incredibly important for how we obviously manage and secure the trust of the educators that we serve. Clearly, I want to highlight as well that the low carbon transition is a theme that we continue to emphasize, and we will be coming back. It crosses all 3 elements of the strategy that I've described to you, and which is incredibly important to our ongoing discussions, but we will be coming back to that in later meetings. So what you'll be seeing from us, from Aisha, from the team and other people, will be multiple revisions to our overall strategy, multiple revisions to our policy going forward. This is but the first, and Aisha's going to talk to you a little bit more about that. But I will emphasize that these policies have been developed with the expertise, we hope, of staff over many years and with the oversight of the board. And your direction and your oversight and your feedback to us is incredibly important. I recognize recognize that there are many constituencies who would like us to change our policies on certain areas, but I hope that we can explain to you how we are trying to take all of those matters in very seriously and consider the best strategies, just like any other element of our investment portfolio, to create long-term return for our stakeholders. So I'm going to pass it over to Aisha, who's going to walk through some of the specific amendments that we're proposing today. Thank you.
Good morning, Aisha Mastagni, Portfolio Manager, Sustainable Investments and Stewardship Strategies. For some of the new board members, and actually just to remind some of the more senior members, the corporate governance policy is going to continue to be called corporate governance. We're going to continue to use that term. And this aligns with the education code. But this policy is what governs all of the activities that Kirsty just mentioned for the Sustainable Investment and Stewardship Strategies team. I think it's important also to note that this is just one piece of the Teachers Retirement Board manual when it comes to investment policies. We also have the ESG risk factor policy and the divestment policy, which are also part of that comprehensive investment tool. Also, unlike other investment policies, the CG policy is actually divided into two parts. The first part includes all of the activities that are related but don't directly involve portfolio management. These are all of our stewardship activities and hopefully what will soon be our strategic relations activities as well. And this is the part of the policy that is actually what I think CalSTRS is best known for. It's all of our proxy voting activity that we take very seriously. It's our engagement activities. I mean, we're really seen as a leader in the marketplace when it comes to stewardship, engagement, and we have countless examples of where we have been able to move the market to make them more sustainable for the long term. The second part of the policy is related to our portfolio management activities. And as Kirsty mentioned, there will be times where we will be bringing this back to you because that's where we're still trying to reshape that portfolio. So lastly, because we would like to come back to the board in future months, we would like the board to approve this version. There are mostly some cosmetic changes to conform the CG policy with some of the standardized formatting that we did for the other policies. So you see a lot of language that's sort of moving around. The other significant edit to the policy is that we did add the activities of the strategic relations team to the policy because we want to make sure they're incorporated. That new language is actually on INV 41 of the marked up version. Lastly, there are some minor changes to the policy, some legacy language that was removed, the trade and wire limits that were removed from our policy because they were added to the overall investment policy. So I'm happy to address any of those if the board has any questions about that. But other than that.
Thank you, Aisha. Thanks, Aisha. Thanks, Kirsty. We do have a few questions or comments from board members on this item. State Controller Yee.
Thanks, Harry, and thank you to Kirsty and Aisha. I really appreciate these items coming back and just really kind of tightening up the overall governance of all of these different areas, and so very appreciative of that. There was one area I noted on INV 46, and it speaks to actually it deletes language requiring a report on the status of current proxy votes. And that's great, so all of that's going to appear on our website, so that's a one centralized place for all that to be. But there's also a provision, I believe it's the second bullet, that suggests deleting language about recommendations to the investment committee for action on proxy votes that are taken that don't fall within the guidelines. And I want to know if that language had been moved, or how do we propose kind of dealing with those particular items going forward?
As you rightly state, this is really old language because we've actually published our votes online for several years now. The other part is We don't vote outside of our corporate governance principles. What we do is we regularly bring you the corporate governance principles for approval. The corporate governance principles guide all of our proxy voting activities. So you would see any changes that we'd be making to any type of proxy voting activity through the approval of the corporate governance principles.
Okay, so those still would come
Yes,
to us?
absolutely.
Okay, great, all right. I just wasn't sure with the deletion of that language, whether that was handled anywhere else in the policy. Okay, terrific, thank you.
Dana?
Let me get back to my question. So you should, if this is not at the right time to ask a question, just let me know. Because we really didn't get into the strategic relations management team, but the write-up talks about it. So do you want me to ask a question about that now? Okay. When we talk about it on IMV 24, and I really didn't get into where it was plugged into the policy, but it says that they would then be responsible for responding to stakeholder requests that are majority focused on corporate governance and broader ESG sustainable investment issues. We're not saying within the framework of what we're putting into our policy that that's, I'm not quite sure how to put it. It's not necessarily all they do. There will be things above and beyond what these things are that they will still be responsible for. And I guess I'm thinking about our constituency group meetings that we have, the strategic relations management team, that they attend that and staff that for us. So while some of those go around ESG issues, they're not always or necessarily corporate governance. So I just want to make sure that they would still be the team that would be working with us with that.
Yes, you're absolutely right. And we're trying not to, recognizing there are these three dynamic areas of both the investment, the stewardship, and the strategic relations. We're trying not to bundle too much together at one go, but we will come back to clarify exactly where Sarah and her team will focus and continue to focus our energies.
Thank you.
Thank you. Thanks, Dana.
Absolutely.
No one else is in the queue. This is an action item. Okay, and before we move on to action on this item, we do have members of the public that are here to address the committee specifically on item 4. So if the members, our guests, could be prepared to speak. We have 10 minutes in total for this item to hear from the public. So we will have a timer, I think it's behind us here, Ms. Fosberg, so the members of the public can see that there's a 10-minute limit to the public comments. So we will begin, let me read off the names of the people, the guests that will be addressing the board on item 4. And once we do, we'll turn it over to Ms. Fosberg. So we have Jane Fosberg, then we have Adam, Rio, and Jasia. Okay, so, and then we have some members of the public after that. So first speaker on item 4, Jane Fosberg.
This comment relates to the language in sections INV 29, 33, and 34, among others. Fossil-Free California would like you, the members of the board, to include in any sections which refer to enhanced shareholder action or actions related to corporate governance or sustainable managers and ESG policy, a statement which includes that CalSTRS can and will employ for financial and environmental reasons, a further bullet point, the practice of divestment. We remind you that CalSTRS is a signatory to the 2018 Global Investor Statement to Governments on Climate Change. This document calls upon world leaders, among other things, to meet the emissions reduction goals of the Paris Agreement and to, quote, support a just transition to a low-carbon economy. Christiana Figueres, the architect of the Paris Climate Accord, warns that we have until 2020, next year, to begin reducing global CO2 emissions. They are currently on the rise. What are you doing right now to ensure your companies reduce their CO2 emissions by next year? You have a powerful tool to persuade fossil fuel companies to reduce emissions and to transition to a low-carbon economy. That tool is the threat, and in this case, the use of your divestment policy. We know that engagement with companies which attempts to alter their fundamental business plan will not work. Likewise, CalSTRS is a signatory to the investor agenda developed by Ceres, CDP, and other investor groups, which seeks to keep the average temperature rise to 1.5 degrees Celsius through activities including investments in the extraction and use of fossil fuels. We feel that active engagement with fossil fuel companies should not end with discussion and mere talk. If a large investor like CalSTRS divested from a fossil fuel company for environmental and financial reasons, the investment community and the fossil fuel industry will pay attention, which they're not doing right now. Divestment by CalSTRS and other large investors may be the persuasion they need to take steps to combat climate change, which threatens our fund and our very existence. Therefore, we request that the language in this document include a statement that beyond engagement, CalSTRS can and will invoke its divestment policy for fossil fuel companies to drastically reduce their CO2 emissions by 2020 next year. Thank you.
As educators, we strive to empower our students by giving them the skills to make informed choices about their lives. Our young people have done their homework. They know that fossil fuels are doing great harm to our environment and endangering their futures. CalSTRS should be at the front of this divestment movement, not lagging behind. Teachers spend their lives shaping the futures of our pupils. I am personally divesting from fossil fuels, and I expect the same commitment from CalSTRS. Fossil fuel investment is not only morally unconscionable, they will soon be a risky investment as more and more people realize the planetary crisis that we are facing.
Yeah, that's who just spoke.
Oh, I'm sorry. Paul Trudeau.
Oh, he's calling names.
Yeah, Paul's here. Hi. Yeah, my name is Paul Trudeau. I'm from Sacramento. My wife has her pension fund in CalSTRS. I encourage you to include divestment in as an option along with engagement. You know, in any negotiation, the person who can walk has the power. You know, if you can walk away from it. So, if you don't do that, then you don't have so much leverage. So if you're not willing to say you're going to pull your money out, you're not really going to get very far, and we need to get pretty far. Thanks.
Karen Perkins.
I'm a retired bilingual teacher. Last night, some of you may have seen some of it, CNN devoted 7 hours of primetime TV educating the public very well about what's truly happening. I was a little shocked. My TV almost exploded from so much truth coming out on CNN, which is not always happening. But at any rate, I thought today I'd walk in and I'd hear an announcement. We're divesting from fossil fuels. And so all I have to do is ask you, what are you waiting for? Because you will divest. You'll either divest by design or you'll divest by disaster. And if you would divest right now, you could avert a lot of pain and suffering and death. You could be a role model, which is what teachers are, if nothing else, for other large pension funds. You could be the first one, the first large one to divest instead of the last one out. You should really read what the writing is on the wall, because even in the debate last night, Andrew Yang said Jamie Dimon is thinking about this matter. So, you know, you really should start really realizing that fossil fuels are of the past, and it's a pretty simple decision. Do you want to be basically part of the past, or do you want to be part of the present and the future? Because we only have 11 years. We have a deadline on this one, And it's real. 99.9% of scientists say that. Thank you.
Thank you. Thanks to the public for your comments. That concludes our 10-minute period for public comments on item 4. Before I turn it over to the committee, I hope this is received with an open mind and a compassionate heart. Cal Stirs, speaking for myself, and I know the colleagues around the table. Yeah, no problem. We'll accommodate you. But let me finish my comment. The members of this committee, myself as the chair of the committee, the leaders of this organization, all care deeply about this issue. Individually and collectively, it's a matter of serious concern and focus for us. To the extent that we've made it a top priority for this committee to look at the transition to a just low-carbon future as our top item for our working plan. The speed of change we disagree on. Clearly, the members of the public who have been speaking with us for a period of time have a point of view that divestment today or yesterday was the right approach. Because we haven't taken that action to date does not imply or mean we don't take this issue seriously. We do. And I know, and we know as a group, we are making inroads on this issue, and we do have a sphere of influence that we're exerting strategically and at certain periods of time. Those are my comments on the matter. I'd like to open it up now to questions or comments of the committee members. The item is an action item before us, and there's a recommendation for some changes to the policy language. And if there are no questions or comments from the committee, I would entertain a motion to approve. Controller Yee?
I'll move the policy revisions.
Okay, it's been moved and properly second to adopt the staff recommended changes to the policy. Any discussion on that? All those in favor say aye. Aye. Those opposed say nay. Okay, the item has passed. Before we move on to public comments, I'd like Can we just put the stuffed animal over here?
Give him his own chair.
Put the other one. I don't want the stuffed animal to be alone. That's what we do it in my house. We got too many stuffed animals. Melissa and Sarah's stuffed animals, put them together so they're not alone. And they feel together. Is that all right? Put them over here. We have many members of the public that are here to speak with us today from different organizations. The committee has heard your request to make some accommodations to the change of time when we will hear public comments. So we're going to amend our agenda item today so that we can accommodate the members of the public that have traveled a couple of hours to be with us here today. So we are going to hear your public comments, and we have 30 minutes for us to hear public comments. And it looks as if all of our guests from the different organizations are here. Staff will inform me if there are members that we were expecting that aren't here. If everyone is here from the organizations that we were expecting to hear from, we will hear the full 30 minutes. We'll make it 31 because there was a request for 1 additional minute, so 31 minutes of public comments that we'll take. But before we do, we are going to take a short break, and then we'll come back and we'll hear public comments from the different organizations that are with us here today for 31 minutes.
Thank you.
Thank you. So the remainder of our open session items are all information items. Should be a little calmer this afternoon. 5A, Alan, semi-annual performance reports. Mika Malone from Makita. Thank you, Mika. And a reminder to the committee, our consultants will be reporting to us here in open session. And then we will have time with them in closed session for items that are more appropriate for closed session relative to their comments and observations on the semi-annual reports. As we did in the morning, at least for the semi-annual reports, what I'm going to ask is for the consultants to present their reports and their observations, and then if there are questions or comments from the committee, we'll take them at that time. So Mika?
Thank you. Good afternoon. The semi-annual performance report that you have in your book, which is, I think, the longest item, the general consulting one in your book of materials, has several sections, and I know that there are probably several board members that haven't had the opportunity to go through a semi-annual performance report like this. So I just wanted to maybe provide a brief background on what is contained in here, because as fiduciaries and with your consultants, this is kind of the chance that we have twice a year to really spend a moment focusing on what we've seen both in the markets. There are a lot of slides in here that help try to frame what we've seen in the markets, and then performance, which can be a little bit overwhelming because you have a lot of not just asset categories, but individual managers within the performance report. Just as a quick reminder, the structure that you have from a governance standpoint as a board is really what we'd consider best in class. So you have a board, you're setting policy, your asset allocation, then you delegate responsibility to your staff to implement those decisions. And then you have consultants who help you hopefully try to get a handle on all of the information that's provided to you. So this is really our chance here to look at the June 30th numbers for CalSTRS. I think rightly, historically, you focused having all of the longer term performance detail in front of you first, and then looking at shorter time periods over to the right-hand side of each page. From my perspective, the items that are really of focus, that we spend a lot of time thinking about the total fund return, you go through asset categories, but in terms of the structure of the report that you have, which is, I believe, well over 100 pages, it's broken into several sections. You have an introduction, which tries to just lay out what's going to be in the report and provides a snapshot of kind of total fund returns and some basic characteristics. Then you walk into some capital markets and risk metric information, which again is trying to give you a sense for where do we sit in the markets as these reports were produced. Then you have a performance review. Within the executive summary component, you have Makita's perspective on each of those various component parts, total fund performance, et cetera. And then you have the very lengthy State Street document that follows. That's really where your custodian bank is putting together all of the returns by asset class, by manager, with benchmarks, gross of fees, net of fees, all of the various data. They like to show it in tables and then bar charts and pie graphs. So depending on what type of a learner you are, with a lot of educators in the room, there should be a page that's right for you if you can get to it and find it. What I will focus on is mostly within that executive summary component, kind of that introduction, which Makita puts on top of the State Street report, but happy to answer questions about really any part of the semi-annual performance report as well.
Mika, when you are referencing items from the materials, if you could reference the INV page number for
Absolutely.
us, thank you.
Sure. So, and what I really wanted to start with, I wasn't going to spend a lot of time on capital markets. These are slides INV 70 through INV 89. And what these are trying to do, again, is just frame where we sit from a risk standpoint and pricing. I'll summarize by saying that as we sat at the end of June, and when you look at that 1 year period, you really have kind of a tale of two markets. So at the end of 2018, you had a period of time where there was a lot of risk aversion, talks about trade wars, a lot of concerns in the capital markets, which caused negative results across most equity and risk assets. Then as we moved into 2019, the first 6 months were relatively positive. The first quarter was especially positive. The second quarter continued to add to those strong results. And so when you come to the end of that period, we're really looking at an environment where, broadly speaking, you have results that didn't quite get you to your actuarial assumed rate of return, and we'll turn to a slide here in a moment and focus on that. But overall, I would say, given how volatile part of the year was, really pretty strong results across the program. If you turn with me to INV 66, This is just the slide that summarizes the performance of the overall program and its broad asset categories. Again, you see 4 time periods that are highlighted here, 10 years, 5, 3, and 1. So I'll make comments on the 1, 3, and 5 first and then focus on the 10 years. What I think stands out to me looking at these reports are that the 1-year return at 6.8% was just shy of your actuarial assumed rate. But again, as I mentioned, given what we saw over the last year, I think a very strong result for the program in difficult market environment. The 3-year performance, 9.7%, well ahead of the assumed rate and also strongly ahead of the benchmark. And the 5-year performance at 6.9, again, riding kind of right at the actuarial assumed rate. All of the columns on the right-hand side of INV 66, what stands out to me is that both your total portfolio and all of the underlying asset categories outperformed their benchmarks over those 3 time periods. That's pretty impressive. So not just your total fund led by one asset category, but really the staff that you've delegated a lot of authority to executing in all of these various asset classes across the last 5 years. So very strong results across the program. When we look at the 10-year numbers, 10.1% for the total fund, that's quite strong. It is trailing the benchmark slightly. And if you look down to the middle of that left-hand column, you see where the underperformance is coming from relative to the benchmark. It's really in the private market space. I know there's been a lot of conversation at the board level and can certainly answer questions, and your staff has discussed in the past some of the benchmarking issues around private markets asset classes. So there's been a lot of thought that has gone into trying to get the best benchmark possible for private markets. But if you go back 10 years and also consider the environment that, as Chris mentioned earlier, the real estate program went through in late 2008, 2009, you can sort of see where some of that underperformance came from. But again, well ahead of the actuarial assumed rate, very strong returns from the overall program. Any questions just on, to me, this is just a nice slide. It also shows you on the right-hand side of the page just where you sit relative to your target allocations at the end of June. And what you see is that you're very closely aligned to your target policy. So as you're thinking forward again to a new asset allocation, Chris mentioned your staff implementing very methodically over the last several years, but you now look very closely aligned to that target policy. If you move forward just a few slides, I did want to note, while I don't like anyone to focus too much on it, you have some peer performance that State Street puts together, and that is on INV, sorry, I'm trying to find my note here. It's on INV 104 through 106. There are 3 different peer groups that are shown here, and you can, the story is broadly the same on each of them, which is you look very strong relative to peers. There are a few data points on the page, so maybe I'll just highlight what you're looking at here. In the bars at the top of each slide, you see your total fund is the darker blue asterisk sort of symbol. And then you see in the triangle what your index fund return is. So where it falls in a quartile ranking relative to peers across 10, 5, 3, and 1 year periods. And then if you prefer to look at it in the table, if you look down to the bottom quarter of the page, you can see total fund, you see the actual performance in each of those time periods, and then you see the percentile ranking just to the right of that. So over the 10-year period on INV 104, you ranked in the 18th percentile relative to peers. This is the public funds master trust universe that State Street puts together. That's very impressive. That's top quartile performance from a very large fund competing with funds of various sizes across the master trust universe. I do want to note a couple of things. It's always nice to note this when you look very good relative to peers, which is that all of your peers have very different liabilities. They have different actuarial assumed rates of return. Their boards have a different risk tolerance, and they're trying to achieve slightly different objectives. So while everyone's goal is to pay participant benefits, everyone's trying to get there in a different way. And these peer groups can't answer that. These aren't all funds that are trying to achieve 7%. They're not all funds that are in the state of California. They're all funds that are serving different constituents and trying to get there in their own way. So while it's, I think, a useful tool to consider yourself relative to peers, it should be really a secondary review point for you as board members. You really want to focus on, are you executing and reaching your actuarial hurdle, and are you beating your benchmark, which is the goal that you're setting for your staff to execute by.
Hey, Mika, I'm Chris Allen, Chief Investment Officer. I'll channel Alan Emkin, which means I owe him a quarter again. Alan's famous line, I've known each other, we've known each other since, 85? Alan will always say, we don't pay benefits with peer group rankings. And that's what matters, is benefits.
My comments are nearly complete here. I did want to note that from a review standpoint as fiduciaries, some of the slides that I find really valuable as well. If you look at INV 93, this is similar to INV 66 that I mentioned earlier, again, highlighting your broad asset categories. There is some commentary at the top of this slide that can help if you're just kind of trying to flip through the report. And then INV 94 really hits kind of the latest 1 year period and tries to help you get a sense for, what was the weight in your portfolio? What was your benchmark weight? And then what did your portfolio return relative to the benchmark return? What we as consultants use this type of a table for is to really help you understand if your allocation, right, were you overweight to equities in a period when equities did well, or were you underweight to equities in a period when equities did well? And that can help you kind of get a sense for what really contributed to the attribution of your performance relative to the benchmark over time. So I think that these slides are nice from that standpoint as well. With that, I'll save any comments on manager roster for a closed session later, and certainly happy to take questions.
Thanks, Mika. Controller Yee, ready?
Great. Thanks, Harry. Thanks, Mika. Just a little look ahead. What's your sense of projections of the market over the next 6 months? No pressure.
I think that from my perspective, and I think that this is shared broadly by Makita, we would expect there to be a continuation of volatility in the market. So we have, while it's picked up over the last year, it's really just in what we'd consider a normal range. So it feels like a big increase in volatility, but the reality is, if you look at history, we're just re-entering kind of a normal time period. It just isn't positive returns month over month and quarter over quarter. So I think that we'd expect there to continue to be volatility in the markets over the coming year.
And you think we're well positioned for the increased volatility?
Yep, I think you're well positioned, and I think that the movements that are being contemplated in terms of asset allocation are, no one tries to time the markets, but in thinking about diversification, what might we see over the next 20 years, I think you're looking to make some really strong decisions related to the fund as well.
Yeah. So a lot of speculation about what could trigger a downturn, but anything that stands out for you?
I think that what we've seen in the fixed income markets is certainly concerning when you think about where fixed income is at today and the yield curve potentially providing some signals that the markets aren't as confident as they have been. In terms of market data, there's still a lot of positive data out there about jobs, about the US market, but I think that has to be coupled with some of the geopolitical issues that we're facing dealing with other countries. And so whether that's trade, the strength of the dollar, some of what other countries are dealing with, and now, even just thinking about Hurricane Dorian and storms, things like that, natural disasters can really have an influence, at least in the short term, on various markets as well. So I don't have a good answer for you, but those are a few things that we think about.
Good. Alan?
Alan Emkin, Makita. If any of us really knew, Controller Yee, what was going to happen, as much as I enjoy coming here and sharing my brilliance, I would not do that. I would use the information for my own benefit and get much more compensation out of that. But it's important to answer your question because it's the question I would ask if I was a trustee. What do you see? And there are definitely positive signs, particularly in the domestic economy. The consumer is still strong, low levels of unemployment, wages are beginning to come up at the margin. So there are some real positives. But as I look at the world, the first thing I see is $15 trillion worth of negative interest rates. There's not an economist who has that in their frame of reference. It's unprecedented. So anyone who says they really have a good handle on what that means is misrepresenting the facts from our opinion. we have some global issues. The fact that the demonstrations in Hong Kong went on for as long as they did, and the level of how that got elevated and how they changed policy, which is really pretty unprecedented, that's shocking because the People's Army, in fact, was moving. And some of us remember what happens when a People's Army moves. That's scary stuff. Argentina basically is on the brink of defaulting on all of their national debt. You have two nuclear nations, Pakistan and India, who are not very happy with each other, and it's very uncertain how that will get resolved. What's going on in the UK is beyond belief. Believe it or not, we don't hear about it much, but what's going on in Italy is equally is challenging. And what's really strange to me is Greece is now being held out as a good working country. Hello? So is it confusing? The answer is unequivocally yes. And what propelled the capital markets globally for a very long time was constantly lower interest rates. And that's the tool that central bankers use to offset slowing downs of economy. Well, you can only go so far negative, and you can only go so low before that tool, that central banking tool that's used to sort of kickstart the economy, no longer has any power left in it. And that's my fear, is that if there is something on a global basis that's negative, how low can you go in terms of providing dry powder? And that's really unclear.